Two quality stocks trading at fair value. This is a video that I do every month or two discussing two stocks that aren't extremely undervalued, not extremely overvalued. They're just quality stocks, quality management. They have some kind of a moat, some kind of a competitive advantage, which allows them to compound consistent returns over the very long term. I have two stocks for today's video. One of them, I've talked about it before. The second one, I've never discussed it. I'm extremely interested in owning it. It has a very high moat. The valuation is a little bit overextended, but I'm gonna talk about it in the video and tell you when I'm interested in buying the stock. Before I get into the video, I just want to thank everyone for watching these series that I've been working on for 2024. One of them is two undervalued stocks to consider. Most of the stocks we talked about in this series have been actually playing out. Like DAC, we talked about it in this video 2 months ago. It was in April, or actually it was last month in April. So from April till now, DAC is so far up 14.3%. and is starting to play out. Even Meta, we talked about it this month, 10 days ago. Meta is so far up 8.5%. Now, in the short term, they're doing well, but in the long term, this is my mindset on them. I don't trade them for a week or two, but they have been playing out. Pfizer has been playing out. Ulta Beauty might start to play out very, very soon. You have some stocks that haven't played out, of course, but the majority of the stocks we talked about in this series, I think you can agree, most of them have been playing out. And I just want to thank you for watching and thank you for engaging with me. It encouraged me to do more of these videos and try to find these stocks for you to share. Now, the first stock I'm going to talk about, which I've talked about before, but I don't really like to be pushed to find new stocks. I always want to find the best stocks for the moment, even though it's the same stock. Sometimes I trade the same stocks for years. I don't have to go find a new stock just to do it. I want to find the best opportunity. And in my opinion, one of the best quality opportunities in the market is ATD Alimentation. This is a stock in Canada. I talked about it. It's down 3% year to date. But if you look at it over the long term, it's one of the best performing stocks of all time, up more than 16,000%. And I just want to talk about this a little bit because this is a challenge I got on my last video, that for some reason a lot of people believe that if a stock is trading near or at all-time high, that means the stock is not a buy or we cannot do anything about it. I mean, imagine skipping Apple, Google, and Amazon at all-time high, even though they were undervalued, but just because they were trading at all-time high. I mean, I could never really understand this mindset, and I was there. I struggled buying stocks at all-time high because I felt I was late and I felt there's no opportunity. But I ignore the price and I focus on the value, and I tend to do much better buying stocks near all-time high than stocks that are trading at all-time lows because the company is going bankrupt. But ATD, I mean, it's down from all-time high. It's down around 12%. And I think the stock is getting pretty close to fairly valued. And the best part is the company has been buying back stock more than ever before. You could see these shares. They've been buying back 16, 15 million pretty much every single day. And it did extend the buyback program. This is the best thing about owning ATD. Every time the stocks goes down after earning, the company jumps in. They have a pretty resilient, pretty amazing free cash flow and a good balance sheet. They jump in and they start buying the stock. They start buying the stock. Same thing before earnings. They start buying the stock. And this is pretty good. If you're owning ATD, the stock goes down. You're going to benefit as a long-term investor if the company is buying back stock at such low prices. And ATD, I've discussed it, they own convenience stores in many different places, in the United States, in Canada, in Europe, and in many different places around the world. Over 16,715 convenience stores. So pretty resilient and pretty amazing business model. Everyone goes to convenience stores on the way. And the main way they were able to be one of the best performers of all time is by creating amazing value per share, expanding book value per share, expanding earnings per share. And the main ways they were able to do it, not just organically, but mainly through acquisitions. They did a lot of smart acquisitions. They entered the United States in 2001. Now, if you go in the United States anywhere, you see Circle K stores. And this is a massive, massive expansion they did in the United States. Then in 2020, they expanded in Asia and they keep acquiring new stuff. They acquire car washes. They integrate them within the system of the gas stations and convenience stores. Lately, one of the largest acquisitions was the assets of Total in Europe, over 2,175 retail assets in Germany and other places too. So it was a pretty amazing acquisition, and they keep doing the acquisitions. And this is why earnings per share has skyrocketed over the years from 6 cents in 2003 to $3.06 in 2023. And this is amazing, amazing stuff from this high quality company ATD. And while earnings per share were going up shares outstanding have been coming down, especially over the recent years as the company found opportunity to use the free cash flow not only to issue dividends but also to buy back stock. And the company is doing many different things within EV transitions. So if people want to charge their cars, they can pay something and charge it near a gas station or in a special area just for EVs, and have a convenience store. So people wait for EVs to charge. They go in the convenience store and maybe they buy something, some snacks or water or something while they wait for their EV to charge. So it's a pretty good business model. It's been working out for them. And I don't think they will be put out of business just because EVs are expanding. Okay. Now, for the valuation of ATD, it's sitting at 17.8 times free cash flow. And it has been struggling in 2024, just like most retailers have been struggling in 2024. And in terms of comp sales, they've just been struggling lately. And ATD is one of these companies. And this is why the stock is down 12 or 13% from all-time high. But it's sitting at 17.8 times a market cap to free cash flow multiple. The mean was 18.6. So it's trading near a mean multiple, near a fair multiple, which I really, really like for the quality of the management and everything. So if we assume no multiple expansion, and although it was trading pretty close to 21 times, but I'm not going to count on 21 times. But let's assume no multiple expansion and no multiple contraction. It stays at 17 times free cash flow. The company, through the acquisitions, they target 15% return on capital employed. And they've been able to get 17.5% return on capital employed. And over the long term, I believe the return of ATD is going to mirror the return on capital employed of 15% or more. So I would expect a 15% annual return. But if you prefer to use something like earnings per share growth, the expectations for ATD is around 12% in 2025, 11, 9, and pretty close to 20%, which I don't count on 2028. But for me, I would say 13, 14 with the dividend and other things. I would say pretty close to 15% annual return. I'm confident we can get 15% with a company like ATD. Now, the only thing is 2024 is going to be slow for a little while. The best part is that the company is taking advantage. They're buying back stock. They're creating long-term value for shareholders. So I don't expect the stock to skyrocket anytime soon. I think 2024 will be the worst year. 2025 is going to be an amazing year as they integrate the assets of Total and many different things and they find synergies. It's going to be an amazing future for this company for the next 5 to 6 years minimum. I would expect a 15% annual return. But I wouldn't be surprised if the stock continued to struggle in the short term, which to me is a buying opportunity, not just for me, but also for the management and mainly for the company, which has been buying back a lot of stock. Now, the second stock is, which I've never discussed, and someone suggested this stock to me, and I looked into it, and it looks pretty amazing. And this stock is CP, Canadian Pacific Kansas City. I believe they recently merged, or it was last year, I believe, between the Canadian Pacific and Kansas City, and they merged into one railroad. It's up 2.5% over the last year. The stock has been pretty much flat since 2021 when they announced the merger. It's like up 9% from 2021. So it's been pretty much flat over this period. And they do own an amazing railroad network. I read some research. I think it's the only railroad network that connects Mexico, United States, and Canada all within one railroad network. And CP owns this network and it cannot be replicated. This is an amazing moat for the company, especially as you consider what's happening in the geopolitical space with reshoring, with the decoupling from China or de-risking, people like to call it, from China. We're importing more stuff from Mexico, less stuff from China. And China is no longer the largest trading partner. The largest trading partner is now Mexico. And a lot of investment is going there, and a lot of expansion have been going into Mexico, and Canada and the United States have been importing more stuff from Mexico. And this is an amazing tailwind for the company to increase volume, increase rates through a monopolistic network that cannot be replicated. So this is a pretty amazing company, very high moat. I mean, it's very hard to lose money with this company over the very long term. But the only thing I don't like is the valuation, which I'm going to discuss a little bit. But this is my kind of company. It's boring. They have a network that cannot be replicated. Amazing, amazing moat. Just really amazing stuff. And I really like their combined business mix in terms of their exposure. 20% is to grain, which is good. Coal, 7%. Automotive is maybe the riskiest one or the most cyclical one. It's 8% of automotive, and they have other energy and materials. But most of it is not really extremely cyclical. And for their network, I really like their position of CP in this area. Now, if we look at their net income margins, they have tech-like net income margins. I mean, for 2024, it's 27%. 2025 is expected to rebound to 29% and get all the way up to 32.5% by 2027. So they have very high net income margins. You have to keep it in mind when I show you the whopping valuation of CP, which is trading at 25 times earnings, which is normally on the high end for a railroad like CP. You have other railroads that are trading at 18 times earnings, 20 times earnings. Sometimes they go as low as 16 times earnings. But CP has an amazing network, amazing rail network that's extremely hard or almost impossible to actually replicate. Pretty amazing network, and they can have higher margins than many other competitors in the space. Now, I can show you another example of a company with a massive network effects, with massive moat that's extremely hard to replicate. And this is a stock I've been watching for years. I was never able to buy it. I always miss it because it looks overvalued. And this is a company called ODFL, Old Dominion Freight Line. A lot of you maybe know the network effects of the company. It's trading at 29.5 times earnings, and it just never comes down. It has multiple expansion, and it just never comes down. And this is the hard part about valuing quality stocks, is not everything can be quantified. How can you quantify the network effects and the moat of CP? It's extremely hard to quantify such numbers, and this is why most of the time we really miss buying these amazing high moat companies, because it's hard to overpay for them. And it's very hard to overpay for CP, which is why I don't own it yet. And I'm still waiting for the opportunity. And I have a feeling inside, I know I'm going to miss it. And I know it's going to keep rallying. And this is my name, the patient investor. So I'm willing to wait on it a little bit. And I'm going to tell you what I see in terms of upside potential. But if I look at the long-term outlook for CP from the management, and I believe this is achievable, and their main target is double digits earnings per share growth. So around 15, 16%. This is what the analysts have. They have 12%, 19, 16, 17, 12. So I would say 15 to 16% earnings per share growth. Now this is very easy. If CP can actually maintain their current earnings per share or their current price to earnings around 25 times earnings, if it stays at 25 times earnings because of the network and maybe more trade into Mexico and they get even more volume, if they can stay at 25 times earnings, then in this case, I would expect the return, the long-term return from CP stock to be pretty close to the earnings per share, which is around 15 to 16% annual return, or a double over the next 5 years, which would be an amazing return for this company. But the thing is, what if this doesn't play out? And what if they get a multiple contraction? This is where the company could not return 15%. The return would be 12, maybe 11% annual over the next 5 years. And this is what I'm trying to look at if I'm trying to buy CP. I don't want to buy it at 25 times earnings. I want to buy it at a lower multiple just in case something happens and the multiple starts coming down. Maybe they have some railroad accident or something really bad happens. They have a massive lawsuit, massive debts they have to pay, like what happened with Norfolk Southern. And then the stock crashes and the multiple gets contracted because of higher debt. So I don't want to end up in this situation. For me, to buy CP, it would have to be somewhere close to $70 per share. And even $70 per share is not undervalued, it's not extremely undervalued, but it's more close to fair value. I would be willing to open a small position, bite the bullet, overpay a little bit, and dollar cost average down, or maybe dollar cost average up if the company actually performs. So this is what I'm eyeing. The maximum is 75. On the low end is 70, anywhere between 70 to 75. I would be willing to open a small position, maybe 3-4% of my portfolio. That's small for me. And a dollar cost average down, maybe take it 5 to 10% of my portfolio. That would be an amazing long-term hold for a high-quality company with a massive moat that's going to compound returns for decades and decades to come. That cannot be disrupted by AI, and it cannot be disrupted by some kind of technology. We're always going to need the railroads, especially when you're taking stuff from Mexico to Canada or from Canada to the United States, and there's only one network that can really pull it off. So it's amazing stuff. I love the company, and I'm really interested in buying it, and I share what I do in my own Discord investment group if you're interested. The link is in the description. So thank you for watching the video. I really hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.